Well, once again, I'm Barry Schultz. Thank you for joining me. It is Saturday evening, and I have found a alternate trend to February 7th for what I believe will be the February 7th low. I'd rather have 3 touch points on the gold wave than on two touch points and one on the green, as you saw in the last video. So I need to update my official call number 6 for 2025 to be February 7th plus or minus 1 business day. So it could fall on February 6th or on that Monday, which would be what? That'd be like February 10th. So I just want to give you a quick update today. And yeah, so it's late evening, but nonetheless, I'd rather have 3 touch points on the gold wave than just 2. So I think this gives a little bit better confirmation because I always say that the gold wave carries the most prominence, most dominance. It's the one that should be listened to the most of all the waves. So I, again, would love to have 3 touch points, or at least 3 touch points on the gold wave for a official call. So thank you for joining me.
Donation QR codes and donation link below this video, and PayPal link below the YouTube video down in the description. Thank you for following me.
So essentially, you have the gold wave here. I backed it up a little bit. You can review the last video if you want. You can see where the 2 touch points were on the gold wave prior, going up to the plus 100. This trend goes out to the plus 50. But nonetheless, it has 4 touch points. You can see the first point is on the very edge of the gold wave, and the last point, number 4, is on the very edge of the gold wave as well. So that's the requirement. And then the middle points can just cross through the gold wave any place. So you can see number 2 just touches the inside of the gold wave, and number 3 goes through somewhat of the meat of the gold wave itself, giving you a trajectory out to roughly February 7th as the official bottom, plus or minus 1 business day. So again, the bottom in markets could occur as early as February 6th or as late as February 10th. As we saw, markets hit their what I believe will be their peak on January 31st, which was minus 1 business day from the February 3rd projected peak. So again, please be aware of the tolerances that I give every time I do the video. If you're not listening to the video, you're not going to hear the tolerances. If you just watch the thumbnails, you're not going to get this information. So it is important, and for those that actually listen to the videos themselves, hopefully it's to your benefit that you fully understand that there's a very specific tolerance that's given to every call. And those of you that watched me in 2022, I'll remember that my purple wave was a plus or minus 4 business day hours. So it was very tight. It was even tighter than this, right? So it was plus or minus 4 business day hours. So you had a half a day, and these require a full day swing, or sorry, tolerance. So it could be, midday on February 6th, late day on February 6th, early on February 7th, early on February 10th, somewhere in there. I'll be looking for an exit on the shorts. Or again, if it stays highly volatile, then I will keep looking for opportunities to short into the bottom on February 7th. What is interesting is last night I was studying the models, and I found a gold wave that was back from April in 2024. And you can see in this picture, this image, around where the black line is just starting to go over the center of the line, you can see that the gold wave is below that very thick horizontal, the black horizontal line. The gold wave actually goes below that there around, what is that, December 17th, I believe. So the gold wave goes greatly below the thick black line back in April of 2024. If you connect those 2 points in time, I believe it's taking you out to the February 7th low. Why is that important? Because if you remember, there was a Jaws trend into January 27th, a very small one. If you want to go back, you can go review that video. But I believe that there is a Jaws trend on the gold wave going into February 7th. So if that's true, we really could see very bloody markets. You can see a lot of selling, a lot of blood in the streets, so to speak, in markets going into February the 7th. But I really like the 1, 2, 3, 4 count here on the gold wave, and I think that's really where you're going to see the bottom, because I'd really like to see at least a three count on the gold wave, as that's kind of been the standard operating procedure up to this point. So I like to keep that going so that the viewer doesn't get confused. And again, let's say around February 5th or 6th, there's some type of flat spot in the market. Okay, let's say futures don't sell off on, let's say, the morning of February 6th. Let's say they just bounce around within this like very tight 10 or 20 point range. Okay, so whatever that high is of that very tight range, you know, if it's let's say it's an even 100. Let's say it's 5,800 on the morning of February 6th, right? Let's say the upper range is from 5,800 down to 5,780. Okay, stays in this 20-point range overnight. The futures do. All right. So then, what you do is, what I would be doing then, my personal own trading style, and you can watch to see if I'm right. You know, you can judge my work, judge my technique. If the upper boundary is 5,800 on the overnight's futures, then I would subtract 50 to 70 points from that high. So then I'd be looking for a low of 57.50 or 57.30, 57.25, 57.20, somewhere in there to start considering going long. Or maybe it could be the same way on the morning of the 7th, right? So somewhere around there, you could see futures go flat, stay in this very tight range, and then fall 50 to 70 points around the 7th, right? Or the 6th, or even the 10th. I'm not sure. I don't know always what date it will be. But anyways, that's kind of how I view my final exit of my trade. Now, let's say on February 4th or 5th, you have a huge down move. Let's say, I'm not saying this will happen. What I'm saying is, if you get some huge move down way before the final bottom date, what I usually do, my own personal trading style, from an educational standpoint, is me personally, I will exit my whole entire short, right? If we fall like 200 points in one day or something, or some huge move down, right? We lose 5%, 4% on the S&P. I'm not saying this will happen. I'm just saying if it were to happen on one of these moves into a low, I personally would exit my full entire short, even though we're a couple days before the final bottom. Because there's usually like a 5 wave count, as I said in the last video, into the bottom. So that big move down could be your wave 3, so to speak. So on some big wave move down, I would exit my entire short, maybe let it go sideways, maybe let's see if it's going to pop back up, and then shorter with a very smaller position, right? So I try to catch the meat of the move, you know, maybe 70% of the way through the time period. So if the whole move down is 5 days, 3 days, whatever, when there's a big move in my direction, that's where I usually I get out of my whole entire position. Okay, even though there's 30% of my time left, I will get out of the entire position because I realize that there's probably like a 5 wave move. So hopefully I catch the 3rd wave on my exit. Then I let it bounce around a little bit, and then I try to take a much smaller position into the high or the low. So some of you wonder, like, well, why can't I just hold it on to the very end? Like, you know, you say your pivot date is this. Why isn't that the best technique? Well, you can go back and study the movements. I mean, you've seen all of January's 5 calls. You can turn on a 2-hour scale or a 1-hour scale and study it for yourself. You know, on TradingView.com, SP500 USD. You can do that yourself, which I very much encourage you to. But what I want to do, because there's some people that just, they're kind of stuck in the mindset that they think that the trade is the full length of time. Well, that's not really the case. You have to study a 5 wave movement. You need to study markets, see how they behave between 2 points. If every move between 2 dates is always a straight shot, then your assumption would be correct. But there's a lot of people that play options and they're time based, right? So you want to catch the biggest swing, and then you want to get out on the biggest swing in that window, right? Just study it. Write down the value of options. Maybe if you're just doing a test, pull up Excel, write down value of options every time you see a huge swing. Track a couple different option chains, and then write down their values throughout the time window, right? So you can prove to yourself if it's better to exit a couple days early or closer or whatnot. But obviously, when markets go sideways, you lose a lot of time value on your option. So then you lose a lot of value on your option itself. So you're really looking for the meat of the move, the lion's share of the move in your direction. And then what I do is I taper down my position very much, a lot, because I want to protect my principal. I want to make sure that I end the time with a win, right? So some of you, there's a couple of you that email me and are very confused, like, why isn't it exactly this? Why isn't it exactly that? To me, it means that you haven't really studied markets, so you have to be open to the idea that perhaps you're not understanding how markets work, right? I'm just a voice. I'm just telling you what my opinion is. The markets behave as they're going to behave. So it's not to understand me. It's you should be trying to seek to understand the markets, right? You can't get mad at me. You need to try to use your time to study the markets, to understand the markets. I don't control the markets. No one controls the markets. We're all just trying to do our best to understand how they operate, right? So being mad at someone is not going to work. You need to sit down and take the time to study markets, use indicators of your own. Understand that markets don't move in one solid direction every time there's a pivot, right? They make some kind of swings back and forth. So if you think, again, I keep on saying this, but you need to understand that there's this tolerance of plus or minus 1 day around my pivot date, but also you need to also understand that when the market moves in your favor extensively, it's not going to last the entire time, right? There's a 5-wave move again between every forecast. There's a 5-wave movement. Again, look at January 27th through February 3rd on the daily scale for SP500 USD. Were all the days green? Were all the candles green? No, they weren't. You get very few instances where all the candles are one color between two of my swing trades. Most of the time you get like a green, red, green, red, green. It's alternating colors, or maybe you'll get green, red, and then 3 reds or 3 greens. You need to understand these things if you're going to make money in this market. You can't think that because you perceive the model to be saying that there's 2 dates and it's a swing trade, that the markets are just going to go down every hour because it's it's going from a swing high to a swing low. If you think every candle is going to be red in your favor, you're greatly mistaken. You need to take the time to study the markets. You need to take the time of studying these 70-point swings. You need to take the time to try to find some way to do wave counts with a moving average or something. But just to say that I'm not explaining it good enough, or you can't figure it out, you're not making money, well, then try something different, right? We each got to keep trying something different. You keep experimenting with our own style, with our own models, until we're making money. And one of the guys I talked to, he says he's just every time he makes a good amount of money, he's exiting now. And that's and he's happy because he keeps on making profits. So I'm happy for him, and that's really the way you got to play this game. Hopefully the pivot points set you up for a really good profit, a really good position. But again, if you think that the market is going to do exactly what you think at the start of the move, it's not. It's going to be different along the way. It's just like driving from the very northern part of the United States to the very southern part of the United States. You may think you're not going to hit any bad weather, but I tell you what, the weather's going to change a lot between North Dakota all the way down to Florida, or from California driving all the way over to Virginia, West Virginia. It's going to be there's going to be a lot of different movements in the road. There's going to be different weather. If you think it's going to be a straight path across the United States and no change in the weather, and it's going to be exactly the same weather and altitude and barometric pressure and humidity levels, we all know that's not the case, right? So don't think that that's the case for the stock market either. I'm saying this because believe it or not, there's a lot of people that think that the market just moves in one direction from one date that's 7 days away or 5 days away to the next in just one straight shot. And they don't understand why they don't make any money. They don't understand why at the very end you actually have to try to time it, or you can't be greedy and wait to the last second. No, it's like life. I don't understand really the question sometimes. Like, people think that the market's going to obey their thoughts. When we get in that mindset, we don't understand markets at all. So you have to be flexible. You have to be on your toes. You have to be like a humble attitude, and realize that when the market starts going your way heavily, you take, you need to consider what your options are at that time. If it's heavily in your favor, maybe you start getting out of it. Maybe you start tapering your position. Maybe you start lessening your position. Again, I have to say this extensively because there's so many times that people get frustrated about this and tell me they didn't understand. They thought they're going to hold their whole position until exactly February 3rd from January 27th low. That's just not the way it works, right? It's once you hit the green in the stock market, call it a day. Don't, you can't always hold the market to your thought. That's why I have to put a tolerance on the window. If it was that easy where I could just call it the exact day and the exact hour, it'd be, wouldn't be that hard. But that's why I give you the tolerance of plus or minus one business day, because you have to be reasonable and flexible. Thank you so much. I got to get out of here. It is time to go. Thanks so much. I'm brschultzSP500. Until next time, see ya.
And again, this model was also picking right around the March 21st, 24th bottom for markets for the major low with a zigzag, a 1, 2, 3 touch point, brschultzSP500. Systematic way of timing markets with a zigzag. And then this is the macro peak for December of 2027. So in a nutshell, in under 10 minutes, maybe near 5 actually, you've got the complete rundown from the macro to the micro to the micro to the macro. All right, race fans, I'll catch you later. Bye.
So hopefully you've enjoyed my show today. Warning, this is all forecast use only. Come here. You want to read this for me? What does that say? Forecast?
Forecast.
Use?
Use only.
Only. Right. And what's this say?
Warning.
Disclaimer.
Disclaimer. I am not
A licensed investment professional. That's Latin. So say caveat emptor. Seek professional advice prior to investing. Investing bears risk
of
financial
loss.
Very good. And so basically this is saying if you ever try to invest in stocks or anything else, you could lose money. Warning, warning, warning. And all my graphs are subject to change. And not all the results are not always the same. Yeah. Thank you for reading for me.
You're welcome.
And that's it for today. I'm B.R. Schultz. Until next time, take care.